Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, I'm Daniel Snyder, and this is ETF Spotlight. Now, we are in a complete new market environment for many investors. Now, if you're a little bit older, it may not be new to you, but we're talking about the environment where treasuries are actually yielding something again. And if that doesn't get you excited, well, maybe dividends or something else might. But today we are joined once again by DJ Tierney from Charles Schwab to talk about the SCHZ fund covering the bond aggregate market. So obviously, DJ, welcome back to the show. Pleasure to have you.
Thanks, Daniel. Great to see you. Thanks for having me again.
Of course. So we got to dive in, right? How should investors be looking towards this fund, thinking about how they approach their portfolio, and what would make this maybe that perfect fit for the bond side?
Yeah. So, I mean, the U.S. aggregate bond index is really the highest profile and most tracked taxable index in the bond market. And so, SCHZ has got over a decade of experience in delivering those index returns. And so what's the role of fixed income in a portfolio? Well, it's to be a ballast and to be an offset versus a lot of the risks in the equity market. So, we're big fans of diversified portfolios. And so we think, to your point, now that there's yield back in the fixed income market, it's a great time to consider maybe talk to your advisor and figure out where you should be with your fixed income allocation. And for a real basic, diversified, taxable fixed income allocation, SCHZ fits the bill. It delivers exposure to treasuries, investment-grade corporate bonds, mortgage-backed securities, and it does it in a really low-cost and tax-efficient way.
Yeah, I would hope to talk about the metrics more here in a moment, but when people think about aggregate bond, and there's a few of them out there. So what makes Charles Schwab's ETF the go-to destination, in your opinion?
Yeah, so we're competitive on cost with an operating expense ratio of 3 basis points or 0.03%. I think that's worthy of mention. And then, and to your point, there are other aggregate bond ETFs out there. So what I would look to what would you want in a provider? What's their history? How long have they been in the market? Schwab Asset Management over 15 years. How long has the ETF been in the market? Over a decade. And what is their historical performance in adhering to the index? And if you look at SCHZ on an annual basis, it's tracked that index within 0.1% annualized since inception. So, it's delivering on its mandate, which is to deliver the index returns. And then on a tax efficiency basis, we've got a good legacy. It has never distributed a capital gain, which is what you would hope and look for in an ETF. There's never any guarantee of the future, but if it's had that ability to not pay out capital gains, that keeps you in the driver's seat. You'll pay your capital gain on your price appreciation when you sell the ETF and not from a distribution along the way. So those are some of the things I would point out that make SCHZ worthy of consideration.
Yeah, I'm glad you brought that up. I know we're going to probably show it here on the screen, the graphic, but the tracking errors for this ETF, A+ grades across the board from the Seeking Alpha quant system here. Plus, you have over $8 billion of assets under management in this fund. That's no small feat, as we're all aware. I think more people are kind of considering, though, well, if I go to the bond market and kind of lock this in, I know what the yield is. But if I go to something else like SCHD, as we talked about in the other episode, there is that potential for a little bit of capital appreciation plus yield. So when people are considering that about their portfolio makeup, what is is there a specific weighting? Is there an allocation? I don't know if you can share any of that, but how should investors really be framing the risk reward scenario here?
Yeah, so it really depends on the investor. What's their demographic, what's their age, time to retirement, things like that. For SCHZ, this is a bond allocation, and so it's really about providing income and capital preservation. And so if you look at the makeup of this portfolio, over 70% of it is AA rated or higher. So these are, on the safer end of the spectrum for taxable fixed income. And, your yield, you can calculate your yield on the day you buy it. Of course, your total return over time will depend on the future, right? If rates go up, that actually could lead to some short-term price depreciation, but then it will actually add your yield over the long term. So, I would say for determining, what percentage allocation should you make for fixed income, that's really a great opportunity to talk to an advisor, and then consider where you are on your wealth journey. We have model portfolios where the allocations for something like SCHZ and fixed income will vary a great deal depending on whether you're in your 20s or you're in your 60s. So, but fixed income and SCHZ can really play a key role in terms of being a ballast and offsetting the volatility that's more likely to occur over on the equity side of the ledger.
Yeah, let's talk metrics real quick. So SCHZ has a dividend yield of 3.95% over the last year and a 5-year growth rate of 3.84%. No easy feat. So for the investors that maybe are looking for the highest yield possible, is this for them, or is this more for that person that's just like, I want to sleep well at night, I want to project my future growth and just set it aside?
Yeah, I mean, there's a spectrum of yields in the bond market, and it's all about risk. And if you start with, the safest end of the spectrum, that's going to be a low duration treasury, even a treasury bill, right? Where inside of 1 year, where you're going to have minimal interest rate risk because it's short duration, and you're going to have minimal credit risk because you're facing the U.S. government. And then, the two metrics that you can really change by moving on the risk spectrum are credit quality, right? So after treasuries, you might consider mortgage-backed securities, you might consider high-quality corporate bonds, and then moving along that spectrum, you can go all the way to high-yield bonds, which have a lower than investment-grade rating. So you can increase your yield by increasing your risk on that spectrum. And then the same thing in terms of maturity. In a normally shaped curve, which we're getting back to again, where yields go up over time, the 30-year treasury yields more than the 10-year treasury, which yields more than the 5-year treasury. You can increase your yield by moving out, but that's not without risk. You get interest rate risk when you move out. So, SCHZ is kind of a nice right down the middle where you've got a combination of treasuries, mortgage-backed securities, and corporate bonds all mixed together. And then in terms of maturity, it's kind of in that intermediate part of the maturity curve where it's not, out 10 years, beyond 10 years. It rests in that intermediate part of the curve, closer to 5 years in terms of duration. So we think it's a nice proxy, to give you a glimpse of the overall taxable bond market, and just a really convenient way. Can you imagine you're getting exposure to thousands of bonds just by buying one equity ticker? It's just it's been a great industry development to give this kind of low cost diversification and easy access to bonds, and that's really the big win with bond ETFs like SCHZ.
I will say my personal opinion is it is a lot easier. I don't know if anybody watching has used the U.S. Treasury Direct website, but man, it needs a little updating. So I want to talk obviously about the turnover asset ratio. 63%. Some investors might look at that and go, well, if they're buying these and holding them for so long, why is there so much turnover? What can you possibly shed light on that?
Yeah, I mean, it's one thing to keep in mind is that the bond market. Every day you go on, you approach maturity, right? So a part of the process here is bonds walk down that maturity and they fall, less than 1 year. They'll drop out of the aggregate bond index, and so if they're not in the index, we'll look to either sell them or redeem them out of the fund in a tax efficient way, and then we'll go buy more bonds. The corporate bond market, issues, $1 trillion in new corporate bonds every year. And, as they come into the market, come into the index, we'll want that exposure. Same thing, mortgage-backed bonds, you might have prepayments. And so really it's just representing what the bond market's doing. And again, why might you be worried about turnover? Well, you might be worried about, generating capital gains. Again, SCHZ since inception has never delivered a capital gain. So your money stays in the market, receiving that income, and then potentially getting some capital appreciation as well. So a tax efficient way to do it. And the turnover, again, is just representative of what the bond market does every year.
I would like to take a second to try to dive in with you, if you don't mind. You're saying mortgage-backed securities. You're saying corporate bonds. people like to think about risk, obviously, as we've been talking about, and treasuries are considered that risk-free rate. But then you start to look at the ratings of the bonds and the mortgage-backed securities. But you're kind of painting this picture that this fund is walking the middle of the line. Now, does that mean that you're only focused on more like AA, AAA bonds and things like that, or is it kind of a diverse approach?
Yeah, it's a diverse approach. So it's going to represent what's in the investment grade market. So, investment grade can go all the way down to triple Bs. But what you'll see with this is that, again, I think I gave a stat, over 70% of the portfolio is AA or higher. Now, that's partially represented by about half the fund is U.S. Treasury or government agency securities, which are at the AAA level. But, in the investment grade space, it can go all the way down to triple B, but you'll see triple Bs make up, right around 12% of the fund. So again, a vast majority is going to be single A or better. So again, it's going to represent we're not making a call here. We are just representing the market as issuant wide levels at the index level.
Yeah, thank you so much. Now, as you mentioned already, 3 basis points of expense ratio. I mean, I want to say for all investors, thank you to Charles Schwab for keeping expenses so low, because I know we all focus on that. But as this market goes forward, let's paint one last picture here. As this market goes forward, there have been whispers of pushing rate cuts out, right? Or potentially even rate hike, depending on what happens. We're watching tariff wars. We're seeing all this stuff happening with the administration. What are the thoughts over there at Schwab and the team about how this ETF might be affected by what's to come?
Yeah, so we have a Schwab Center for Financial Research, which consists of people that just do just what you said, look at the market and really try to make calls. And so, Kathy Jones is our fixed income strategist for Schwab Center for Financial Research, SCHZ, we like to call it. And, she's constructive on investment grade, and she's even constructed on the absolute level of yields right now. And again, we don't have a crystal ball, so we don't know, where the 10-year Treasury or corporate bonds will be yielding in a year from now. But, based on the quality of balance sheets for aggregate, corporate bond issuers, I think she feels like they're in a pretty good place. And then just in terms of a historical yield spectrum, your entry point right now, with the 10-year Treasury north, if you get into the market when treasuries are between 4.5%, high 4%, that generally has served you pretty well. And again, with corporate bonds adding incremental yield to that, we think if rates stay in this spectrum of kind of 4.5%, 4.75%, it's a reasonable time to get into the market where you've got some cushion against volatility with rates moving forward.
DJ, let's go ahead and leave it there. Thank you so much for jumping on the program. Again, everyone, the Schwab US Aggregate Bond ETF, SCHZ. Go ahead and click the follow on the symbol page here on Seeking Alpha. DJ, we look forward to the next episode. We hope you take care, and we'll see you here soon. All right.
Thanks, Daniel. Goodbye.